Welcome, entrepreneurs, students, and taxpayers. This is The Tipping Point, a show devoted to individuals trying to get ahead. We scour the region for the most competent individuals in their business-related fields and allow them to educate us on their specialty, because knowledge is power, and with enough power, you can tip the scales in your favor. I'm your host, Gabriel Velez. The Tipping Point is brought to you by Terrani and Velez, a tax and accountancy firm headquartered in Irvine, California, catering to closely held businesses. As a reminder, if you like today's content, please remember to like, share, and subscribe. Today's guest, Chasse Cole, mortgage broker at Arbor Financial.
Well, let's see, a little bit about myself. I am a former recovering banker.
Yeah.
Been a banker for the last 12 years of my career, so I originally started out in consumer finance, helping households with their consumer debts.
Uh-huh.
This is going back to 2005 when I graduated from University of California, San Diego, and realized pretty quickly that people can get in and over their heads on debt. So that was an interesting career choice when I got out of college. Didn't really know what I was going to do, but really liked to be around money. And it was tied to real estate, which I found fascinating. So I guess in the beginning, dealing with the small households and consumer debt opened my eyes up to the world of credit and real estate. And, the meltdown happened in '08. That's when I realized I needed to find something else. And I've always wanted to be an entrepreneur. So what better way? I like being around money. Wanted to be around small business owners, so I delved into the business banking world.
So what was it about the big bank that kind of turned you off or made you become a recovering banker?
Well, the challenges I always found was, earning a living. There was always geographic restrictions. There was always clients that were maybe tagged, and you just couldn't really provide the services. I mean, my business has always been built on referral networking and working with other small business owners, other centers of influences in the world of finance. So I'd be getting introduced to clients, and sometimes there would just be red tape that I couldn't help them on, and that would get kind of irritating from a sales standpoint. But big banks, they just it can be tough. Their credit appetite is, it's smaller. They don't want to take a lot of large risks, and there were deals out there that were doable, and I would see them get done, but they would get done at maybe other institutions that were smaller and willing to take on more of a credit risk, which I found is what I really wanted to do, was place clients with the right types of banks that would get the job done. So.
Okay, and
But I was a little selfish and greedy.
You were a little selfish and greedy. Okay.
Like, hey, we small business guys, we want to grow and make money.
Right, yeah, and so you had to say no to a lot of deals while you were at the big bank.
And so I used to jokingly call myself a commercial decline officer, even though my title was a commercial loan officer. It was a joke, but it's just you would look at a lot of deals. So I looked at a lot of deals. I just would have to pass because it wouldn't fit some criteria or another.
Okay, so they were looking for like a credit box, right? People
Sure.
with a high credit score, a lot of money in the bank, good cash flow if it was a business, strong balance sheet. So, like, can you make that a little bit more material for us? What is a creditor? Like, if I'm a business owner and I'm looking at my balance sheet and I'm looking at cash flow, like, how does that compare to me trying to go out and buy a commercial piece of property?
Sure. So what's an A credit profile?
Yeah.
The bank joke is someone who doesn't need the loan. But honestly, an A paper credit criteria, this would be someone who's probably got a lot of personal liquidity. Their cash flow year over year is very strong. So that means that maybe from a small business owner, their sales trends are either increasing or very stable. Their profit margins are healthy. They don't deplete their business of all the earnings, and they're low leveraged. So that would be an ideal borrower for a bank, because that to them might be someone who's not as high a risk as someone that's maybe starting out and isn't profitable, hasn't been established for greater than 3 years, and might be in an industry that's a little bit riskier.
Okay, and are those people usually best suited going out and getting like a standard loan as opposed to like something like a SBA loan?
Well, yeah, I mean, an A paper credit, someone that's been established and is doing very well, they're probably going to qualify for a conventional type of loan with the bank. That's, a facility that's normally short term in nature. A bank's going to review on an annual basis, or even on a conventional, let's say, real estate loan. They can put more down than somebody that might not have been established as long and isn't as profitable, but wants to grow and wants to expand. So my idea of an ideal client in the SBA world is someone is growing, is starting to make a profit, and maybe they need a little more leverage than a conventional borrower, so they're going to take advantage of the SBA programs that are available. There's two types of programs for a small business owner under the SBA. They've got the 7A and 504 programs. So those are two different types of programs, but they're available to help small business owners grow and expand.
Okay, and am I using these 7A products and the 504 products to finance only commercial real estate, or can I use those to finance, let's say, buying a whole new business, or finance a build out, or I can use it for any one of those?
Okay, so what's the differences of the programs, right?
Exactly.
7A can be used for, it's a general purpose loan. It can be used for purchasing real estate. You can use it to acquire a competitor. It can be used to start up your business. It can be used for working capital and equipment. A lot of lenders in the 7A world, they kind of start at about a $250,000 loan limit, and it's capped at a $5 million maximum exposure. A 504 loans typically, and I say typically, it's for real estate purchases. So a small business owner that's maybe leasing a space that wants to go out and identify a location for themselves, or maybe they have the option to purchase the facility they're at, they can use a 504, an SBA 504 loan program to acquire the building. That the leverage on that is 90%, so they can put as little as 10% down and qualify. So it's the most common programs available. There are some other ancillary SBA programs, but the prototypical ones that are being used by small business owners, either a 7A or 504, and it depends on which institution you go to, whether they'll offer fixed rate or variable rate loans.
Okay, so let's start with startups. Like, let's say I have a startup business. Obviously, I'm going to have probably a business plan, right, with some kind of projected financials. Is that something that's necessary to qualify for one of these programs?
Well, a startup, in general, is going to be the riskier of the types of programs that are out there. Banks are going to scrutinize those based on the industry, the relevant experience of the borrower. If you're looking to open up a restaurant and you've been, doing mortgage loans, there's probably not a correlation with the two. But they're going to want to see a business plan. They're going to want to see your resume. They're definitely going to want to look at your liquidity. So do you have money to put into this project? Because the SBA isn't going to finance 100% of it. Okay, so you have to have what we call skin in the game. And on a startup, normally you're going to want to put down 25%. You're going to want to have, if you have contracts in place, that'll help substantiate the projections. And, if you've got a home and you've got equity, or maybe you've got other real estate holdings that have equity, you may be required to pledge those as an additional form of collateral, because again, the SBA doesn't want to be left on the hook for a loan and all of a sudden the borrower's business maybe fails. Again, a startup, more often than not, their likelihood of failing usually within the first 5 years. So they would be looking at those available assets to secure that loan. So it's a great program for small business owners to use. It's available, and there's several options, with small business banks out there that are willing to take the risks.
Okay, and like in your experience, mostly startups are needing an SBA or a 7A, either the 504 or the 7A plan. These are going to be industries that are capital intensive, right? So like, why would you need a loan if you were an attorney kind of starting out, or an accountant kind of starting out, right? We're talking more like restaurants, maybe your medical or dental professionals who need a build out, need to go and finance. If it's a dentist, they need dental chairs, they need specific plumbing. if it's a restaurant, they need to come in and have a build out new stove, all the kind of high end appliances and everything, right?
Yeah, you're absolutely correct on that. They'll do working capital, but a lot of times it's designed for the guys that are going to need the equipment. They're going to need the build out space, and maybe a small amount for working capital to pay the overhead that's going to be needed. I mean, you're going to have payroll needs. You're going to have furniture fixture needs. You're going to have even some advertising costs. So each industry is a little bit different, and they're going to, a medical professional, for example, some programs are going to be available for them to get maximum leverage because they're less likely to fail than maybe, we'll take the highest risk industry we talk about, which are restaurants. Most restaurants fail within a couple of years. And it's not it can be the most challenging industry to get because, again, they're going to look at the borrower's resume and history to see if they would qualify for something like that. So direct experience is going to play a factor.
Okay, and then if you have a semi-established or a fully established practice, restaurant, business, are they going to have to come up with 25% in order to maybe, let's say, move their operation into a building or condo space? Or are they going to be able to, do it with a little bit less skin in the game?
Yeah, so a small business that's been established and kind of fits the criteria. Well, the criteria, again, is you've got at least greater than 3 years of in business, you're profitable, kind of low leverage, then no, they're not going to have to necessarily put as much down on a project if they're looking to expand. And expansion, I mean, if they're buying real estate, you can put as little as 10%. If you're looking for working capital or maybe to acquire a competitor, typically about 20% down is going to be the requirement. And again, if you've got personal collateral you can pledge on the real estate side or maybe more cash, they're going to look to be fully secured if it's available. But it's a great program. And, there are conventional loans too for someone that's pretty liquid and solvent and it's got very strong ratios. It could be even a conventional loan option for them.
Okay. In my space, you don't see a lot of conventional loans, although obviously if you can qualify for it, it's cheaper, right? They don't ask for as much collateral. But, you're going to see a lot of SBA loans when you're dealing with small businesses because they just don't have the necessary capital to put down a 25% and kind of A plus, credit rating, right? So if there's a client or if there's somebody out there that's looking to get an SBA product, what kind of things can they expect to kind of pledge or to collateralize? Is it basically a blanket, like anything with equity that they own is going to be collateral for an SBA loan?
Ooh, so I would say to get prepared, I mean, the first thing in the due diligence process is you want to have your financials in order, and your banker's going to look at a personal financial statement. So on that statement, they're going to look at the available assets you have. They're not necessarily going to look at your vehicles personally or maybe your retirement account because that's not even eligible. They're going to look at really your real estate holdings. First is going to be your primary residence. Do you have any lendable equity in that? If you do, and there's a collateral shortfall, then they're going to want to put a lien against that for the shortfall amount. They'll look at the business and does it have assets that can be used to pledge? I mean, they're going to look at a blanket UCC filing if it's available. So they're going to look at unencumbered equipment, accounts receivable, inventory, and cash. But, I always start off with the personal financial statement so I can see what kind of assets the borrower has so we know up front, hey, this might be needed to pledge to get this loan qualified. So I would say, the advice I give to small business owners is get your ducks in a row, have your tax returns organized, have your CPA prepare your financial statements, and put together a personal financial statement so we can look at your cash flow, look at your liquidity, look at your available assets, and determine, is this the right route to go?
Got it. Okay. All right. So let's move a little bit away from that and let's talk about what are the typical terms of a loan that you're looking at, like if you're going out to acquire a commercial property?
Yeah. So on a purchase for a small business owner, if they're going to take advantage of an SBA loan, you've got, again, those two options, a 7A or a 504.
Yeah.
So a 7A loan normally is going to be a one loan with the bank. So you're going to be dealing with just your bank, or maybe a community bank or a credit union that's offering SBA loans, even some non-bank SBA lenders that are out there. So a 7A is going to be a 25-year loan, fully amortized. You do have fixed rate options. A lot of lenders do variable rates, and the variable rates are normally tied to prime and adjust on a quarterly basis. So prime-based loans, I would say. But some A paper borrowers that have got clean credit history and real strong financials, you can get a 25-year fixed rate loan.
Okay, let's break out of this Q&A, and I just want to kind of hear some of your either horror stories or champion stories, or what kind of things are you working on right now?
Sure. So, well, just recently, a small business owner, he's a contractor. So contractors in general are usually high-risk industries because they're very cyclical in nature. This guy had been around. He's been established for a little over 10 years, but was turned down by a couple of the big banks. He's looking for just a small retail office space he can put his shop in, and was turned down. And the reason being is they just didn't have the historical cash flow. But I was able to identify a small bank that was willing to give him an SBA 7A loan, so maximum leverage going about 90%. He only had 10% he could put down, but he did have available equity in his home to pledge. So to mitigate that shortfall, they put a lien against it in second position on the home to help him buy that building. And it was, one where he'd been in escrow for a while. His due diligence period was coming up, and we were still able to deliver on time, which is the key, because that can be a very stressful situation for a small business, being in escrow and worrying about getting your loan approved and, getting turned down. I mean, that can be a challenge.
Right. Okay. So 7A product, it's a government-backed loan, right?
Right.
The government writes the criteria for these loans, right?
They do, and banks have their own interpretation of the policy too.
Okay, so a smaller bank might just be a little bit more aggressive.
A little more flexible.
Yeah, got it. Yeah, versus Bank of America or Chase Bank or something like that.
I won't name them.
You won't name them. One of the big three might just have maybe they learned their lesson from 2007 or something.
Yeah, I mean there's right now there's just a huge push for these SBA products. I mean, banks are willing to, offer these loans to help small businesses, but they're looking to originate credits. And I see right now that the smaller banks and even credit unions are acting a little more aggressively than maybe a big bank. But again, if you've got a very clean credit with real strong financials, they're willing to originate those fixed rate credits for them. It's just got to fit that when I talked about earlier, that small credit box. Yeah. It's got to fit their ideal client, or they might pass on the deal. So you've got several options out there, though. And I mean, the 7A is just one example. The 504 is still really strong, and they've made changes recently on the second mortgage. They're looking to do a 25-year product. It hasn't been out yet, but it's likely coming out here in the next couple of months. So it could be an even greater option on the real estate side.
Okay, are SBA loans specifically for like user occupied properties, right? So you're going to have to actually move into the property you're purchasing. That's part of the agreement, right?
Yeah, it's not going to be eligible for an apartment building. Yeah, it's not going to be eligible for traditional investor real estate deals. It's designed to help a small business grow and occupy a property. And initially they don't necessarily have to occupy 100% of the space. They can occupy just the majority, 51%, and lease out the rest, but their qualifications are going to be based on their business and their business's ability to repay. So no, it can be used as I see a lot of small business owners purchasing properties because it's part of the retirement strategy. Eventually they might sell their business and, they've got a free and clear building, they'll lease it back and live on that as a source of income. And I'm sure you've seen that too.
All the time.
Yeah.
We have plenty of real estate investors here, living off of 15, 20 units, some commercial, some residential. So I see that all the time, and I think real estate's a great way to build wealth. Specifically in Orange County, the real estate's sexy. So, people go out and they buy it, and they look for the appreciation. You're not going to get the kind of cash flow that you might get out of state, right? But you get a good amount of appreciation, and in the long run, the real estate in California is really sought after, right? So
it's hot, it's desirable, and inventory right now is really at an all-time low. I mean, that's why I'm starting to see owner users wanting to build their property on available spaces that they can find. So that's key. It's not just for an existing facility. You can actually use it to build out a brand new facility.
Okay, so in your experience, let's talk about, we've been talking about more like user occupied. We've been talking about, businesses trying to expand and trying to get a place to call home for their business. Let's jump over to the investor side,
Okay.
People who aren't looking to run their business out of the property that they just purchased. So they're looking more of a conventional route if they need to finance, right?
Right. SBA wouldn't be an option for something like that.
SBA wouldn't be an option. Okay, and then so like how much down are we looking for? Is it 20 to 25% typically?
Well, investors typically want as much as possible, right? But from a lender standpoint, the property on a standalone basis has got to qualify, and there's what's called a minimum debt coverage ratio requirement. And most properties in California right now, at least in Southern California, don't qualify for just 25% down because cap rates are really, really suppressed. You're typically having to put more, maybe 40, 50% down to meet banks' criterias for cash flow coverage. So out of state right now, which is honestly, I think really, really hot. You're still seeing a lot of buyers or investors, I should say, sell properties they have in California. They may have purchased it in 2012, 13, seen a nice run in appreciation, and they're taking those gains and rolling it in out of state. So maybe out of state, you might be able to get 75, even 80% loan to value.
Okay, so this is like, banks are looking at a lot more than they would be looking at on a residential piece of property, it sounds like, right? So like they know that this is an investment, that they're not trying to, put people in homes. They're trying to make sure that the business of investing in real estate is actually going to be profitable. So they want more equity, they want more skin in the game, and they're actually looking at the potential returns on that investment before they're going to make the loan.
Well, yeah, they want to make sure that there's enough cash flow coverage. So if, let's say, the market changes, or for example, maybe your occupancy dips below the 100% you underwrote it at, it's going to be maybe 85%. Will it produce enough cash flow to meet the debt obligations? So banks don't want to be stuck like maybe in 2007 and 8 holding the bag with properties that weren't performing because there's occupancy issues and it's not able to debt service the loans that they originated because, the market rents were above and now they're suppressed.
Okay, what kind of areas are out of state have you, because you finance all over the United States, right? You don't just finance in California.
Yeah, I'm going all over.
Where are the hot locations these days that people are really trying to invest in?
Yeah, I mean, the major markets right now are tough. So I'm seeing a lot of investors going into secondary markets, maybe even tertiary. So they're looking for higher cap rates than a major market might produce. So I'm seeing deals still. Texas is going strong, Florida, North Carolina, Arizona, Washington was hot, and those have been the ones that I've seen pretty consistent. Now we're starting to see Vegas and Reno too.
Okay, and is the bank looking at the different uses? So are they going to treat like an industrial property, right? Lending on an industrial property versus lending on like an office property versus lending on like an apartment building? Are they going to be treating those differently?
I still see. It's crazy to me, but on a multifamily seems to be the most aggressive. You don't necessarily have to produce tax returns to qualify. They're going to analyze the property and the market data, and they're going to determine if it's a strong enough property to support a high leverage loan. So if the borrower's got the net worth or personal liquidity, usually about 9 months of payments and reserves, you're an experienced investor. So you're not just maybe brand new getting into a 20-unit apartment building. You're someone who's been established, has got a strong schedule of real estate, and has got liquidity. You can buy these properties without tax returns. Now going into maybe office, retail, No, they're going to look at financials, they're going to look at tax returns, and they're going to determine, is this a property they're going to want to put on? They might even do an environmental report, right? Like a phase 1, maybe a phase 2, to make sure that the property's clean of any environmental issues. So I think multifamily is, in my opinion, the hottest right now.
Yeah, I mean, you're dealing with multiple tenants, but
Pretty recession proof. I mean, people need a place to live.
Yeah, exactly. And as the economy goes down, more and more people tend to rent, right? And so so that makes a lot of sense. All right, what other war stories do you have for me?
Oh boy. Okay, what's going on lately? I think the one challenging file I've been looking at for a while. It's been tough. I'll share this one. It was a multifamily property in Texas.
Okay.
So again, going into those hot markets, Texas, it's the 1031 exchange. The clients identify the property, clients in escrow. What happens during escrow? 4 units burned down.
This property sounding familiar? Go on.
Yeah. 4 units burned down.
Yeah.
I don't know what to do. I don't know how to get insurance. Your building's burned down. It's too late to pull out. So the client's either got to make a decision to move forward or, pay the taxes. And luckily, we were working with a lender that had the ability to do a bridge construction loan. And then once the construction's complete, put it into a perm loan. So that was a pretty nimble lender we chose to work with, because I don't know a lot of folks that are willing to take the risks on a property that's uninhabitable, or at least a portion of it, right? So you're initially cash flowing it based on 20 units. Well, now you only got 16. So that was a very unique experience, because I've never run into that. Now, I have had a building burn down after the fact. So I financed a client's apartment building in Illinois. It was Rockford, Illinois. And about a month later, a tenant left a pot on a stove overnight, and I guess it exploded and caused a fire. You can probably Google the address and see the news report on it. But that was another unique experience.
Rockford, Illinois?
Rockford, Illinois.
Okay.
And last year in September, I guess there was a really big hurricane going through Florida.
Okay.
And this is on another 1031 exchange.
Yeah.
So
1031 exchanges are hot. People don't want to pay taxes, right? They want to defer the taxes
exactly
until the very last second.
So
maybe death.
So a hurricane came through,
yeah,
and came through Fort Myers, and that's where the property was located. It was in Fort Myers. I thought, well, we're done. I mean, this is going to take months to close, because the property is going to be either damaged, destroyed, or just uninhabitable. Luckily, it was deemed, I think, a natural disaster. So I guess on a 1031 exchange, if it's
presidential declared,
yes,
yeah, disaster zone.
You have a little more leeway.
Exactly.
Luckily, the seller was accommodating too. Jeez.
Yeah, which parts of California are considered a disaster zone? They announced that probably earlier this year, due to all the wildfires and things like that. So, people who had a hard time, getting transactions done might look to that for some relief. FYI.
Those were interesting experiences. I mean, yeah. I've learned a lot from those. But yeah, I guess going back to 1031 exchanges, those are hot. Yeah. And where are people taking their appreciation, their gains? They're taking them out of state. I think with the advent of technology and the ability to, see things remotely, work with property management companies that can show you live feed of the property, people are looking at out of state. And I think it's a younger generation too, because these are younger borrowers I'm dealing with.
Millennials?
Oh,
are they millennials?
They
are we allowed
millennials.
to say? Are
Actually,
we allowed to say that word?
They're slightly older than me. I think I'm barely a millennial.
Okay, you're barely a millennial. So millennials
Early
make money
40s.
too sometimes.
Yeah, was that a Gen Xer, Gen Y? I don't know.
Yeah, maybe something like that. Okay, all right, sounds good. Good war stories.
Oh yeah.
Yeah, I have some war stories too, but I can't share them. Maybe some other time. Okay, so not only do you do real estate loans, you also do business acquisition loans, right? And so, is there such a thing as a conventional loan for business acquisition, or generally not for small business?
There are available, absolutely. Banks in general are going to want to see a business that's, again, low leveraged, that's got great cash flow to support, because a lot of times a conventional loan on like a business acquisition is going to be much shorter in a term than an SBA loan would be. So if you're looking at a conventional loan, it's going to be usually 3, 4, maybe 5 years. An SBA loan, if you're using it to acquire a competitor or buy out a partner even, they'll go as long as 10 years. So that really helps with cash flow, right?
Yeah, absolutely.
So if the business is well capitalized, it's got strong financials, and the borrowers are pretty solvent, I think you can explore a conventional loan, but most often than not, you're going to look at an SBA loan to back that, just because of cash flow. Yeah,
and it's probably a little bit easier pill for the bank to swallow, right? If there's actual like tangible goods. So like if you're buying them like a manufacturing business or even a dental office, you do have some tangible goods, right?
Right.
Versus like an accountant or an attorney where like there really isn't tangible
goodwill.
goods. Yeah, exactly. Goodwill, right? All of the cost is in the goodwill and in the client list and that stuff. So it's probably easier if you actually have tangible collateral, right? That they can throw it like a UCC filing on there or something.
But if you have a government guarantee, then it makes it a little bit easier to qualify for it too.
Yeah, a little bit more expensive, right?
Sure. There's cost associated with getting a government guaranteed loan. You're going to have the guarantee fee.
Yeah.
So, but it gets...
What does that typically run?
It's a percentage of the loan amount. So
it depends on the size
varies
of the
on the size of the loan, but typically on a 7A, I would quote 2 to 3% of the amount you're financing.
Yeah, and it gets folded into
usually
the amount
rolled
financed.
into the loan.
Okay.
Rolled, I like to say rolled in.
You like to roll, not folded in. Yeah. Part of this podcast is actually learning the other person's lingo, right? What exactly do they say, and what does that mean? Okay. So what else do we got today?
I was thinking SBA would be the route because it's hot right now. Helping small businesses. What else? What are you seeing from your clients? Are your clients asking about anything specific?
I have a few dental clients right now that are kind of running around. They're independent, but they're looking for somewhere to actually, put their roots. And then I also have other medical clients who, maybe they're renting, maybe in like, the Newport area, super expensive, high rent, and they're looking to get away from that model. They're a little bit more established, and they're looking to go and, actually get themselves a property. And, being in relatively the same area is important. They don't want their patients to kind of have to travel too far.
Too inconvenient.
Yeah, too inconvenient, exactly. Especially when you're dealing like in the Newport market, right? People want some kind of convenience, they've earned it. So, so those are the types of things I'm looking for or looking at right now. And, definitely the guys who are independent and they're dentists and they're looking to go out and buy a practice, they're probably not that A+ creditor that we're looking to, that you're looking to, get a conventional loan. They're probably going to have to go SBA route. And then the more established, physician that has been in practice is paying the high rent, and they actually do have some assets. So maybe they would be able to fit into something like a conventional loan, like you were talking about.
Well, SBA is not a bad product, especially if you're looking to get as much leverage as possible, because you're limited on maybe down payment resources, or, it doesn't hurt. If they've got a wealthy uncle, they can always get gifted funds, right?
Oh, that works not just with residential. It actually works with business loans as well.
Yeah, just as long as you can trace where the funds are coming from.
Yeah, it has to be a little seasoned.
Yes.
3 months or
60 days.
60 days. Okay, 2 months.
2 months bank statements.
Okay, great. Okay, if we want to start wrapping this up, we've been at this for a little while. I like to end with a word association game.
Okay.
So I'm going to throw out some terms. You can respond with the first thing that comes to your mind. It could be a definition. It could be, maybe an emotion tied to some of these things. I don't know. You tell me.
Is this a surprise?
Exactly. All right. Cash flow.
The ability to repay the debt. 1.25.
1.25.
That's the normal cash flow ratios I think of.
Okay. That's how much they would be able to qualify.
Yeah.
Okay. How about
debt? Bad.
Yeah, in general, bad. Yeah, sometimes
Too much.
a necessary evil.
Right, to expand.
More of a Band-Aid.
Yeah, it's again growing up with my career, starting off in the consumer world. I always thought of debt. Oh, bad, too much leverage.
Yeah.
But the right amount of leverage, using it properly to expand and grow, get a return on your investment, can be huge. Got to use it appropriately.
Yeah, here's the deal, right? So, and I see this all the time too, and it has a huge impact in the tax world, which I'm a part of, right? In that, the concept people need to understand is that debt is being paid with after-tax dollars, right? And so maybe in one period you finance something and you don't want to pay taxes, so you decide to maybe Section 179 a piece of equipment in that period to wipe out your tax liability, right? But the following 2 to 5 years, you're having to pay off that debt, right? So cash flow is going out the door, and you've already written off that piece of equipment. So in these next few years, not only is cash going out the door to service the debt, it's actually going out the door to pay your taxes as well, right?
Right.
So so I'm 100% on there. Like, if you know that you're making a deal with the bank, with the banker, and you understand what what the repercussions of that are and how to actually plan for your cash flow, it could be a very good thing. You can buy stuff that like a business that is going to generate cash flow. It's going to generate income that maybe you otherwise wouldn't be able to purchase, but everybody,
you're on the hook.
You're on the hook. Yeah, you got to pay it back.
Debt.
Yeah, exactly. You
Personally
gotta pay,
guarantee it.
You got to pay the piper, right?
Oh yeah.
Okay. Let's see. Last term for the day. Hard money.
Ooh. We like to call it private money.
Yeah. Is hard money a derogatory term?
Hard money. So I equate them as flexible. Going to get the deal done some way or another. Mm-hmm. You want to get out of it as soon as possible.
Are bridge loans usually hard money?
They're not bank terms.
Sorry.
But they get the job done. And if you can get out of it as soon as possible, that's ideal.
That's ideal.
But they're flexible, right?
Yeah.
There's an interest rate for every kind of loan.
Yeah.
And if someone can still generate a profit and get a nice rate of return,
right,
that's not necessarily a bad thing.
Yeah, and I think
sometimes we call them Band-Aids.
That's more of a Band-Aid than just regular debt, right? So, I had an experience where we actually needed to use what did you term it? Not hard
private
money. Private money, right? We actually had to use private money, right? Because there was a loan from a conventional bank that had come due, and they were barking at the door wanting the owner of the property to liquidate the property, and the property wasn't ready to be liquidated. It needed some renovations. It needed to be they had a business that needed to actually move out, right? And so the private money actually the bridge actually provided us the time to package all these things up and get top dollar for the property versus having to fire sale it, right, and get less money. And so, at that time, it was actually, a good thing. It's a Band-Aid. Yeah, it costs money, but it got the job done.
Costs money, but you make money too.
Exactly.
If used correctly.
If used correctly. All right. Anything else? Do we got anything else today, Chase?
Do I put a plug in?
Do you put yeah, absolutely. So how do people find you?
Oh, perfect. Well, my website's thecommerciallender.com. And if you want to speak with me because you have questions about conventional loans or SBA loans, give me a call at 949-777-8938.
Thank you so much, Chase.
Awesome. Thank you.
It was awesome.
Fun times.
All right. Thank you so much, Chase.
Awesome. Thank you.
It was awesome.